All right, today we're tearing into Cricut's latest earnings report. Now, on the surface, it looks pretty good. A solid beat, a nice little pop in the stock price. But if you dig just a little deeper, there's a pretty big warning sign that the market might be overlooking. So let's get into it.
So here's the big question, right? Cricut beats earnings, the stock jumps, everything looks great. So why on earth would the CEO come out and say he was disappointed? That's a huge disconnect, and that's exactly what we're going to unpack today.
Okay, first things first, let's look at the numbers that everyone saw right out of the gate, the headline figures that got investors initially excited.
Cricut came in with fourth quarter earnings per share of 4 cents. Now, Wall Street was only expecting 3 cents. So that's a nice little beat right there, a solid start to the story.
And what about revenue? Well, for the quarter, they pulled in $203.6 million. To be fair, this just squeaked by expectations of $202.47 million. But hey, in this kind of tough consumer market, any beat is a win.
And here's what the market did. You see those numbers? And this is the knee-jerk reaction. The stock shot up over 4.7% in after-hours trading. Looked like a clear victory, right? Well, this is where the story gets a whole lot more interesting. All right, now we're going to peel back the onion a bit, because when you look past those headline numbers, you find a company that's really moving at two different speeds. It's kind of like a split personality. And here is that split clear as day. On one hand, you have their subscription service, Cricut Access. That's their high-margin, recurring revenue, and it's growing by a healthy 6%. Love to see that. But, and this is a big but, the actual products, the machines and the craft supplies that bring new people in, that's down 8%. And that right there is the core of the issue.
But hold on, don't go writing them off just yet. Financially, this company is a fortress. They are sitting on a huge pile of cash. We're talking $276 million. And get this, they have zero debt. That is a massive safety net and gives them a ton of breathing room while they try to fix this product problem.
So this all brings us to the earnings call. And this is the moment where the tone from management completely changed the story, steering it away from that simple, happy earnings beat.
This is it, the most important part of the call. The CEO, despite all the good subscription news, was totally candid. He said they were disappointed in the lack of total company sales growth. That one little phrase tells you everything. It tells you that inside the company, they know they have a problem, that the headlines just aren't showing.
So what are they going to do about it? Well, they've laid out a three-part plan. First, they're launching new hardware faster to get people excited again. Second, they're making the software way simpler with guided projects to get beginners on board. And third, they're moving to a bundle-first strategy, packing more stuff in with the machines to make that first purchase bigger. But the real question is that actually going to be enough to move the needle?
A company doesn't exist in a vacuum. So to really get the full picture, we need to zoom out and see how Cricut's performance stacks up against everyone else. This is where you really feel the pressure.
Wow, this chart really says it all. Over the last year, Cricut stock is down 17%. Meanwhile, the broader consumer discretionary sector, all its peers, is up almost 8%. That is a massive, massive underperformance, and it explains exactly why management sounds so urgent.
Okay, so what does this all mean? We've looked at the good, the bad, and the plan. Let's pull it all together and make our call on what's next for Cricut stock. So it really boils down to this. You got two camps. The bulls are looking at that rock-solid balance sheet, zero debt, and that beautiful growing subscription revenue. The bears, though, they're laser-focused on those shrinking product sales and are asking, can these guys actually execute on this big turnaround plan? It all comes down to execution.
After weighing everything, our rating is market perform. Look, the company's amazing financial health and that sticky subscription business give it a really solid floor. But the challenge of getting people excited about their products again is huge, and it's very real. Until we see hard proof that their new playbook is actually driving sales growth, we think staying neutral is the right call.
And of course, as always, just a reminder that this explainer is for informational purposes only. This is not financial advice.